Welcome back to Investing Talk Podcast.
Today we're looking at Microsoft.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm find other investors like you who are trying to cut through the noise.
And speaking of noise, there was a deafening amount of it this week around Microsoft. I think for most people, for decades really, Microsoft has just been the Windows company.
For the Excel company.
Right. But after digging into this quarter, I'm starting to think of them differently. I'm looking at them as the AI infrastructure monopoly.
That is a massive title. You don't just throw the M word around lightly.
I don't, but look at the setup here. They just beat earnings across the board. Revenue, beat. Operating income, beat.
Earnings per share, beat.
By all standard metrics, it was a home run. And yet, what did the market do?
It threw a chair through the window. The stock tanked 6%.
Exactly, through a tantrum.
Yeah.
And we have to figure out why. Because, usually when you beat earnings, the stock goes up.
Well, I think I know why. And it's the elephant in the room. I was looking at the report, and my jaw it hit the floor when I saw the capital expenditure line. The CapEx.
The spending bill.
It's absolutely astronomical. Correct me if I'm reading this wrong, but did they really spend $37.5 billion?
They did.
In just 3 months.
In just the second quarter of fiscal year 2026, yeah?
Surely that's a record.
It's a massive acceleration. It's a 66% increase year over year.
Okay, let's just pause on that. A 66% increase. So they are spending the GDP of a small European nation just to build data centers and buy chips.
Pretty much.
This is what spooked everyone, right?
Sure.
As an investor, I see that number and I think, this is reckless.
Yeah.
Are they just burning cash on GPUs that are going to be obsolete in 2 years?
And that is the core question. Is this reckless spending, or is it the construction of a moat so wide that, Amazon and Google simply cannot cross it? That's what we need to unpack. Because if you just look at the expense line, you panic. But if you look at the hidden metrics, specifically the bookings, you might see a completely different story.
Okay, well, before we get to the hidden stuff, let's look at the balance sheet behind this bill. How are they even paying for all this?
So first off, the sheer scale of the revenue engine is, it's hard to wrap your head around. Total revenue for the quarter was $77.7 billion.
Oh.
But the real story is the shift in where that money is coming from. Cloud revenue alone surpassed $51.5 billion.
Wait, so the cloud segment is now, bigger than everything else combined?
Effectively, yes. Cloud revenue grew 26% year over year. The intelligent cloud segment specifically grew 29% to nearly $33 billion. But here is the number that matters if you want to understand the future of this company.
Okay.
Azure.
The cloud computing arm.
Right. Azure growth accelerated to 39%. That is the fastest growing major segment in the entire business.
And that's a critical distinction to make.
Yeah.
Because I was looking at the classic Microsoft parts of the business, and they look, dead.
They're definitely not the growth engine.
More personal computing, which is basically Windows and laptops, was flat. 1% growth.
Yeah.
And Xbox content actually declined 5%.
Right.
So if I'm an investor holding this stock because I think people are buying more Surface laptops or playing more Call of Duty, I'm wrong.
You are looking at the wrong thesis completely.
Yeah.
This is officially a cloud story. It's not a Windows story anymore. The legacy business is just a cash cow that funds the cloud expansion.
Which brings us right back to that massive spending bill.
Yeah.
Because 39% growth in Azure is great, but it's expensive to fuel. You mentioned $37.5 billion in spending. There?
Yeah.
Where exactly is that money going? Is it land? Buildings?
A lot of it is hardware. About 2/3 of that $37.5 billion went specifically to hardware, GPUs and CPUs.
See, that's the scary part for me. Hardware depreciates. Land holds value, but chips gets lower every year, relatively speaking.
That's the valid fear. Investors look at that and say, okay, you're burning cash faster than you're printing it. But here's the counter-argument that the market initially missed.
Okay.
They aren't burning cash reserves. If you look at the cash flow statement, operating cash flow is keeping pace with the CapEx increases.
So they're making enough cash from the business to pay for the expansion without dipping into savings.
Exactly. They are generating so much cash from operations that they can afford to dump $37 billion into servers and still return capital to shareholders. In fact, they returned $12.7 billion to shareholders.
In the same quarter.
In the same quarter. Dividends and buybacks, that's up 32%.
Okay, so management is confident. They aren't hoarding cash for a rainy day. They are spending it because they see something. Which brings us to this hidden metric you teased. You said there was a number that explains this.
Yes. Everyone is obsessed with the expense line. But you need to look at commercial bookings.
Okay, break down bookings for me. How's that different from revenue?
Think of revenue as the cash register ringing today. You know, you bought a sandwich, you paid $5, that's revenue. Bookings are like a catering contract.
Yeah. Okay.
You sign a deal to provide sandwiches for the next 3 years. The money isn't in the register yet, but the contract is signed, locked, and legally binding.
I follow. So what did their signed contracts look like?
Commercial bookings grew 230% year over year.
Hold on. 230%.
And 230%.
That is absurd. For a company the size of Microsoft, I mean, usually you see numbers like that in a tiny startup.
Exactly. It is absolutely massive. And it feeds into another acronym you need to know. RPO, Remaining Performance Obligation.
Which is just the fancy accounting term for the backlog, right?
Right. It's the total value of all those catering contracts. That backlog is now $625 billion.
$625 billion. That's bigger than the GDP of most countries.
It's up 110%. And here is the kicker. The average duration of those contracts is 2.5 years. So when people ask, is the AI demand real? Is this a bubble? Microsoft is sitting on a 2.5-year pipeline of locked-in revenue.
Okay, that completely changes the context of the CapEx for me. If I have signed contracts for $625 billion in my pocket, spending $37 billion to build a factory, that isn't gambling. It's just fulfillment.
Precisely.
Yeah.
You have to build the kitchen if you sold the catering. And this speaks to their whole strategy, the integrated AI stack. They aren't just selling server space.
Right.
They are embedding Copilot into Office, into Azure, into Dynamics. Once an enterprise signs up for that, the switching costs are incredibly high.
Right. You aren't going to rip out your entire operating system and retrain your whole staff just to save a few pennies on cloud hosting.
It's the classic Microsoft strategy, lock in, but now it's powered by AI and backed by a $625 billion guarantee.
So if the internal engine is running that hot, why is the external paint job, the stock price, looking so scratched up? Let's pivot to the charts to see how the market digested this.
The price action was really a tale of two cities, or maybe a tale of two emotions, I guess.
It felt like a fake out.
It was a classic fake out. So earnings dropped on January 28th. Initially, the algorithm liked it. The stock rose, about 0.63% in after-hours trading.
Right, to about 483.
Exactly, and everyone breathed a sigh of relief.
For about 12 hours.
Right. Then the sun came up, the analysts started doing the math on that CapEx bill we just discussed, and reality set in. On January 29th and 30th, the stock fell 6%.
It was a sharp drop. I mean, a 6% on a company this size wipes out billions in market cap. But looking at the chart now, is this a falling knife or is it an opportunity?
I look at that chart and I see a psychological setup. This is what we call a CapEx skepticism pullback. The market sells off on the sticker shock of the spending.
A knee-jerk reaction.
It is. It's a knee-jerk reaction to the cost, ignoring the RPO we just talked about. But this creates a setup for a potential reversal.
You think the selling is overdone?
I do. History suggests that when a company like Microsoft beats on the top and bottom line, but drops on investment fears, you often get a relief rally once the dust settles.
Once investors realize the cash flow actually supports the spending.
Exactly. So it's essentially a show-me story. The market is pricing in fear right now, and that fear creates momentum for a short covering rally. I mean, think about it. If you shorted the stock because you thought the spending was reckless, and then Azure shows even a hint of reacceleration in the next update, you are in trouble. All those institutions that sold or went short are going to have to chase it back up.
So the technicals are basically screaming oversold.
Yeah.
But let's see what the street is screaming. Because sentiment usually drives these short-term moves.
Well, if we look at the sentiment, it's surprisingly gloomy.
We pulled the quantitative sentiment score from Alpha Vantage. It's sitting at negative 0.112. That is categorized as slightly bearish.
Which is. It's rare for Microsoft. I mean, usually they're the golden child of Wall Street.
Well, the headlines are driving it. You have headlines like, Wall Cent futures tick down as Microsoft's slump weighs. That's a very heavy negative framing. It frames Microsoft as an anchor dragging down the whole market.
And then you have the traders who are just neutral. You see headlines lumping MSFT in with random industrial stocks. They're throwing it in a too hard pile.
But do you think this sentiment is disconnected from reality?
I think it's completely disconnected from the fundamentals. And there's a specific news item that got buried this week, which I think completely validates their strategy.
Okay.
The Perplexity deal.
This is the AI search company, right? The one trying to kill Google.
Right. Perplexity inked a $750 million 3-year deal with Microsoft. Now, here is the kicker. Perplexity has publicly stated they like AWS. They use Amazon for a lot of things. But for their heavy lifting, their AI model deployment, they chose Azure.
And why does that matter? It's just one startup.
It matters because Perplexity is an AI-native company. They know exactly how this tech works. If a cutting-edge AI company, which has choices, chooses Azure despite preferring Amazon elsewhere, that validates the technical superiority of Microsoft's stack.
That is a strong signal. It's like a race car driver choosing a specific engine builder. They know what's under the hood.
Exactly. And then there's a rumor about Amazon itself, the rumor that Amazon is planning to invest $50 billion into OpenAI.
Right. My first thought was, that's bad for Microsoft. It dilutes their influence over OpenAI.
On the surface, yeah. But flip it around. If Amazon, the cloud leader, feels the need to throw $50 billion at OpenAI, what does that tell you?
It tells me they're desperate to catch up.
It tells you that Microsoft's partner, OpenAI, is the only game in town. It validates Microsoft's entire thesis. It proves that you have to spend this money to compete. It proves Microsoft was right to start spending 2 years ago.
It's validation of the whole sector. It basically says Microsoft was right all along.
And it highlights what we call the analyst gap. You have the CFO, Amy Hood, explicitly confirming they exceeded expectations on everything. But the sentiment is negative. That gap, that is where the opportunity lives.
Okay, I'm feeling pretty bullish based on the bookings and the validation.
Yeah.
But let's take the other side. Let's look at what could go wrong. Because even with that massive backlog, you don't spend $37 billion a quarter without some risk.
No, you don't. And we have to be realistic here.
Risk number one has to be ROI, efficiency. The stock is down because of this doubt. The specific danger zone here for me is margins. I saw that cloud gross margins are currently around 67%.
Which is down from, what, 71% last year?
Exactly. That compression is happening because of this spending. If that continues to drop, if we see cloud gross margins drop below 65%, doesn't the whole thesis break?
It certainly gets shaky. If margins compress too much, it means they are spending $1 to make, $1.05. That's not a software business, that's a grocery store.
And the fear is infrastructure bloat. What if they build all these data centers, buy all these GPUs, and then AI usage stalls? What if the hype dies down? Then you're left with depreciating assets and a massive electric bill.
That is the nightmare scenario. The field of dreams risk if you build it and they don't come.
And then there is competitive pressure. We mentioned Amazon. AWS is waking up. They aren't going to just let Microsoft take the AI crown without a fight.
Not at all. And there is an adoption risk, too. Are companies actually using Copilot enough to justify the price hikes? It's one thing to buy the license.
It's another to renew it next year.
Right.
Is it a novelty or a utility? I mean, I have Copilot, and honestly, some days I use it, some days I forget it exists. Yeah.
If
If I'm a CFO looking to cut costs, isn't that subscription the first thing to go?
That's a valid concern, but I think we have evidence that it's becoming sticky. Look at the Microsoft 365 commercial cloud revenue growth. It's at 17%.
Okay.
That suggests that Copilot is driving adoption, not hindering it. And more importantly, this insulates them against the pure play guys. Because if you are a generic cloud provider, you are fighting on price. Microsoft is fighting on productivity. They are selling you a workflow word, Excel, Teams, Copilot, all integrated.
It comes back to that lock-in. You can't fire the operating system of your business.
Exactly.
All right. It's time for the final decision. We've looked at the massive spending, the incredible bookings, the technical fake-out, the risks. What's the score?
I'm giving this a bullish score of 7.5 out of 10.
7.5. That's fairly high given the market sentiment is technically bearish.
It is. But I see Microsoft as a CapEx to cash flow conversion story. You have to look past the sticker shock. The fundamentals, that 230% bookings growth, the $625 billion RPO, those are incredible numbers.
So you view the 6% drop as a mistake?
I view it as a tactical entry opportunity. The market is pricing in the cost, but ignoring the signed contracts that justify the cost.
I tend to agree on the tactical play. I think the sticker shock is temporary,
Right.
but I'm keeping a tight leash on it. I want to see those margins stabilize. If they drop below 65%, I'm out.
Fair enough. So for you listeners, here is how we are looking at the target horizons.
If you are a trader looking for a swing,
If you are swing trading, you are looking for, say, a 15 to 20% relief rally leading into the Q3 earnings, which should be around late April 2026. The thesis is simply that the market gets over the shock.
and for the long-term investor, the buy and hold crowd.
For the 2026 to 2028 horizon, this is a compounding thesis. You're looking at a 3 to 5 year hold, targeting maybe 12 to 15% annual returns. The driver there is the lock-in of the AI stack. As AI becomes standard in every office, just like email did, Microsoft becomes the utility provider for the global economy.
It's a compelling argument.
Yeah.
The infrastructure bill is high, but the rent they're collecting is getting higher.
Exactly. Strong fundamentals offset the sentiment headwinds.
Well, that's the breakdown on Microsoft.
Mhm.
Is that an expensive bet on the future? Yes. But do they have the contracts, that backlog to back it up? It looks like they do.
And with the stock down, you're getting a discount on that future.
If you want us to cover your portfolio, subscribe, like, and comment below. We'll see you in the next one.